and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
There's something very different about this downgrade than the last two. The first one, S&P, was all fears that government dysfunction. We'd just gone through the debt limit. There was this question of whether political paralysis could lead you to not pay the debt back. This time, it's unified Republican control, and what Moody's is concerned about is what those unified Republicans will do. Right now, they are set on increasing the debt, with the only debate being by how much.
I think it's cavalier and premature to say buying the dips. It's also premature, I think, to say you need to run for the hills. And it depends on what type of investor you are. If you're an aggressive investor, okay, fine. You can buy in the dips. If you found that a 20% correction or close to it freaked you out, maybe this is a time where we've recovered, where your overall allocation to equities was too high to begin with. If you can't withstand that from a psychiatric standpoint, maybe you reduce your exposure. So that's where we are.
Two of the big announcements, one being NV Fusion, sort of opens up the walled garden. A lot of people have looked at Nvidia and kind of called it the Apple of the AI ecosystem. Everything has to be all Nvidia. And while this NV Fusion doesn't completely make it, say, open in the sense of making all of the different chip makers available to the different NVIDIA infrastructures, it does open up CPUs, like the one you mentioned from Qualcomm just a moment ago, to be able to pair with NVIDIA.
We got 1 hour to go until the market close, so let's take a look at the major averages. Obviously, the big news today, Moody's downgraded the credit rating of the U.S. from AAA to AA1. It's the third of the major credit rating agencies to do so. And when this first happened back in 2011, when S&P did it, it was kind of a big deal, right? Although it didn't quite have the market effect, one would think, but we'll get to that later. In any case, it doesn't necessarily have a big market effect today either. Initially, stocks are trading lower. The Dow is now higher by almost 100 points, about 1/4%. The S&P 500, very little changed. And the NASDAQ composite is down by 0.1%.
And it's interesting, Joy, because so Moody's, when they make this move and they cut the credit rating, if it was a market that was interested in an excuse to throw a fit, a headline to throw a fit, you could have been it, because it does remind you, or at least puts into focus and highlights these very real challenges, fiscal challenges and debts and deficits. And you did see an initial reaction. If you looked at the broad gauge, the S&P 500, I think the low today was down a bit over 1%, but you can see how the buyers moved in. We basically battled roughly back to the flat line here. And the bond market's relatively calm too. It's not to say that the market can find a reason to throw a fit after a big move off an April low, but this does not seem to be it.
Well, at one point, on the 30-year in particular, we saw 5% for the first time in a couple of years. And then we saw that yields start to come down. So interesting activity there. This is actually a little bit of what happened in 2011 when the U.S. got the first downgrade. One would think that you would then have selling of bonds and yields going higher. And instead, because people said, oh, this is a risky thing that is happening, they bought into the bond market, sending yields lower. So it was a little bit of a counterintuitive move that we saw in the bond market at this time. I keep coming back to what Rick Reeder of BlackRock told me back at our Invest conference in November. He said the bond market pays attention to the shark closest to the boat. And he said at some point, this concern about fiscal deficits, about debt to GDP, about all of these issues will get closer to the boat and will have a bigger effect on the bond market. But he said it's not happening yet. And even if this big spendy bill gets passed, big, beautiful, by the way, also spendy bill gets passed through Congress, and even if we see fiscal spending go up a lot, is it still going to be the shark closest to the boat? I guess we have to wait and find out.
Yeah. Well, for more on the latest market moves, let's welcome in here Sam Stovall, CFRA Research Chief Investment Strategist. Sam, it's always good to see you. So let's start there with what we were just talking about, Sam. So Moody's makes its move, it cuts its credit rating, Sam. The response in the market, we did see that dip, Sam, the SPX. I think at the session lows, we're down about 1%. Now we battle back basically to the flat line. What does that market response and reaction tell you, Sam?
Hey, Josh, good to talk to you again. Well, it's basically like a ping pong ball dropping on a table. The first response back in August of 2011 was the highest, with the S&P actually getting near bear market territory, dropping a total of 19.4%. But as each successive bounce occurs, it becomes more and more muted. So this morning, I think investors basically yawned and said, tell me something I don't know. And that's how they're reacting to that downgrade today.
It seems to be, Sam, not so much an indicator, new information to the market, as much as a reflection of what has been going on, where we have seen sort of incrementally interest in non-U.S. assets start to tick up this year. Even with the rally back from the lows in the S&P 500, we still talk to a lot of investors who say, we're still looking internationally. Just a little bit of a knock on the value of U.S. assets in the eyes of international investors as well. Is that how you see it? Do you still see that happening?
Yes, I do, Julie. Basically, at first, investors were saying, yes, the large cap stocks are expensive. They've been driving the market, really driven by a handful of issues. So let's take a look at the mid and the small caps. They're trading at 30% discounts to their longer term relative PE ratios. But that didn't work out as the market began to worry about recessionary indicators. And traditionally, the mid and small cap stocks do not do very well in recessionary periods. But then the thought was, well, let's take a look at international, because they too are trading at very large discounts to their historical PEs. They've also underperformed the S&P 500 in 12 of the last 15 years. So if you believe in reversion to the mean, and really you're just looking for better opportunities as well as higher dividend yields, then overseas offers a nice, attractive alternative.
Sam, I'm looking at treasuries here. As Julie mentioned, the 30-year briefly top 5% earlier. We're relatively calm here now, Sam. I mean, the 10-year, I'm here at 4.46. Is there a level, Sam, that you think for the benchmark 10-year poses a kind of challenge for the equity market? Is there some special level you would be watching?
Well, the 5% level seems to be that level at which point investors do start to worry, even though the longer term average going back to the early 1950s for the 10-year is average about 5.75. So the average is certainly a lot higher than where we are today. So I would tend to say that we would have to go above the 5% level for investors to really get worried. But I believe that with the most recent CPI and PPI data coming down a bit, being a little cooler than investors had been anticipating, I think that now the Fed watchers are saying, yep, I have a little more confidence that we will see 1 or 2 additional rate cuts in this year by the Federal Reserve. So I think overall the trend is downward for the long-term interest rates as well as for the rate of inflation.
So, Sam, you touched on a number of the different things that investors have been watching so closely this year, right? And I think we can put them broadly in 3 buckets. The tariff bucket, right, or the policy bucket more broadly, the earnings bucket, and the Fed, right? Right now that this sort of worst case scenario for tariffs is off the table, how do you think investors are rating those in terms of importance and what they're watching?
I think they might have swapped tariffs for earnings, because if we are seeing an easing of the trade discord and the hopes that, well, we got an agreement with the UK, we have a pause period with China, maybe things will be working out with other countries. The question is, prices lead fundamentals, right? Okay, well, fundamentally, we have seen earnings expectations for 2025 be cut nearly in half. It started the year where expectations were for about a 13% year-on-year rise for all of 2025. Now that estimate, according to S&P Capital IQ consensus estimates, is 7%. So I think we're going to have to see many more upward revisions to full year earnings estimates before investors really feel confident that the worst is behind us.
Sam, how would you broadly characterize valuation here?
Well, I would say that look to the shorter term averages to feel a little better about valuations. If you look at a 20-year average PE ratio for the S&P 500, it's trading between 1 and 2 standard deviations from the mean. If you look at 10 years, it's only between the average and 1 standard deviation. So PE ratios are not really a good timing tool, but they can show vulnerability for the market. And if you also look at Buffett's favorite investment indicator, which is the market cap of the S&P 500 versus nominal GDP, we're really at all-time highs at this point.
And Sam, finally, as you put all this together and try to figure out what the best strategy is right now, if you're a long-term investor, do you think buy the whole S&P and that's it, or do you think there are better ways to sort of optimize here?
Well, I like to focus on sectors.
Yeah.
And I've always felt that after a decline, a double-digit decline, that you want to rotate from first to worst, meaning you move out of those sectors that did the best during the decline, usually defensive, healthcare, consumer staples, utilities, and into the 3 worst performing sectors and 10 worst performing sub-industries during the decline, because they tend to outperform the market by a good percentage, 44% to 34% for the market and 60% for the sub-industries versus that 34 for the market. So right now, essentially, you'd want to be sticking with communication services, consumer discretionary, technology, and then money of the high flyers like automobiles, independent power producers, semiconductors, et cetera.
Sam, great to talk to you as always. Thanks so much.
My pleasure. Thanks.
We're just getting started here on Market Domination. Coming up, Nvidia CEO Jensen Huang providing a keynote speech earlier, making remarks on the company's next era in AI infrastructure. He was at Computex in Taiwan. We're going to get to the latest on the other side, plus a cloudy day for solar stocks. We'll get you caught up on all of today's top trending tickers later in the hour. Stick around, much more Market Domination still to come. Nvidia coming out with some new product and tech announcements at Computex. It's a big expo in Taiwan. Their CEO Jensen Huang provided a keynote speech. He made remarks on the company's next era in AI infrastructure.
$300 million chip industry to a data center opportunity that represents about $1 trillion to now an AI factory, an AI infrastructure industry that will be measured in trillions of dollars. And this is the exciting future that we're undertaking.
For more on what's ahead for the chipmaker and others that it's working with, Bernstein Managing Director and Senior Analyst, friend of the show, Stacey Raskin is back with us. And Stacey, Jensen Huang is known for making grand statements, right? So far, it's worked out pretty well for him. But as we try to tease out from that keynote what is most important for the company and for shareholders, what stands out to you?
I mean, look, so you're right. He does make sort of grand statements on the opportunity in front of him. And so far, his track record on that's pretty darn good, right? So I think, at a high level, that continued confidence, and the idea that they're kind of on this path towards something even greater than what they are, I think for the long-term investor is very important. There were some very interesting, like nearer-term announcements as well. There were a bunch of products and everything. I mean, fine, but I thought the most interesting thing was that they are opening up what they call their NVLink technology to third parties. They're kind of NVLink is a like a high-speed interconnect that allows them to connect many GPUs together. And so far that's been proprietary to Nvidia. And so they are partnering with a number of the AI ASIC vendors, Marvell and MediaTek and Allchip, as well as some of the CPU vendors, some new ones like Fujitsu and Qualcomm, to now make this available for third parties to further sort of grow their ecosystem into other parts of the market where they're currently not. I mean, they right now are sort of actively competing with them. They're going to try to go. So I thought that was very interesting. It's not something that at least that I had expected them to do. But that's what they're doing. So that was one of the more interesting announcements that I saw.
And that idea, Stacey, of opening up the ecosystem to other chip makers, why do you think they made that decision? An announcement now, one, and then the partners they announced, Stacey. So Marvell, MediaTek. I'm curious to get your take on those partners, but also your take on who we didn't hear about.
Yeah, no, you bet. And so they sort of kind of announced it a little bit before. They announced something with MediaTek at GTC that sort of implied some of this. And so this gave us a little more concrete details on what they're doing. Yeah, look, I mean, so they are partnering with other ASIC vendors, again, like a Marvell or an Allchip or even a MediaTek that make AI ASICs for other players. Look, I think in some sense it probably is an acknowledgement that the ASIC opportunity is real. And look, I figure like if folks are doing ASICs, they're going to do them anyways. Like you might as well try to extend your ecosystem into that and make them partners as much as you can. So I think that's fine. You asked like who was not in it though. It is interesting. Intel and AMD and even Broadcom. So they actually have a competing interconnect standard. It's called UA-Link. I think it stands for Universal Accelerator Link, I think. But it's like an open source competitor to this NVLink interconnect technology that they've been trying to build. And so in some sense, this is encouraging other players not to go down that route, but rather to partner with NVIDIA on that interconnect technology. I could also imagine that those other guys, Intel and AMD and Broadcom, probably be less interested potentially in partnering with NVIDIA, and they're clearly not. They're going to go try to do their own thing. But you are sort of setting up a couple of different paths, and you already have one. I mean, the NVIDIA ecosystem is already pretty well established. To the extent that Jensen can help to drive that into some of those other areas, it puts a lot of pressure potentially on some of the up and coming ecosystems. It's always hard to get new ecosystems kind of like traction to get them started anyways. So this probably makes it harder.
Well, one of the other interesting partnerships that they announced that Nvidia talked about, or I guess Qualcomm talked about, is with Qualcomm. Because Qualcomm is now going to make custom CPUs that will work with NVIDIA's GPUs, as I understand it. And I was reading a recent note of yours where you talked about that you're what feels like a lonely bull on Qualcomm. So I was wondering first your reaction to this news and then how it feeds into that thesis on Qualcomm.
Yeah, you bet. So last week there was a lot of announcements that came out of the Middle East. And Qualcomm even there had announced a partnership in the Middle East, I think with Saudi Arabia, to make chips effectively for AI data centers. And I would say as of last week, it was a little bit unclear how that was going to work. Like, so they were going to do CPUs, and then what? Like, so at least now we have a better idea of probably what those plans are. They will presumably be data centers with NVIDIA GPUs. And then, the GPUs have CPUs that go along with them. They will be Qualcomm CPUs. And now it's clearer how those CPUs will actually work with the NVIDIA GPUs. So I think it makes that entire opportunity for Qualcomm at least more credible. I think more broadly, look, people have not, Qualcomm's been tough. It's been a smartphone story. Investors have been kind of hesitant to play smartphone stories. They have an Apple headwind, which is very well known, but Apple is starting to do their own chips and designing them out. And so it kind of limits the headline EPS growth for a while. At the same time, there is a real diversification story, and Qualcomm's talked about this pretty extensively across auto and IoT and other things that makes them less dependent on handsets over time. And there's an AI edge story, which I think they are a beneficiary, but this makes the overall like AI story for Qualcomm better, I think, and it's clearly not getting any kind of AI multiple. The stock right now is about 12 times earnings. Even if I took all of Apple out, maybe it's 14 times earnings. But it makes that diversification story, I think, even more credible than it was. So I think it's good.
Stacy, final question. Spinning ahead, NVIDIA earnings on tap next week, the 28th. Stacy, what are some of the questions top of mind for you on that print?
Yeah, there's some near-term worries just because of the China bans. They were banned from selling this H20 part in China, which is meaningful. I think I saw an article just today that said Jensen had kind of sized it, potentially $15 billion. And, that's kind of in line with what we had thought. And, I think they're supposedly trying to work around some of the new constraints. And so it's very possible that some of that revenue comes back. But I mean, does it impact in Q2? It very clearly might. I don't think that'd be a shock at this point. I think that's anticipated. But I think some of the noise around China near term is certainly a concern and a question. I think there's also some of the supply chain stuff. This Blackwell transition has been challenging. It does look like they're in production. Jensen made some comments on that last night. But the ramp of Blackwell, like into the end of the year and into next year, I think will be a question. And then clearly, as this stuff from the Middle East and maybe from other places starts to ramp over the next several years, like how can that contribute? Investors have been worried that 2025 could be a local peak for CapEx. And I would say the only ones that have really been worried about that are investors. Like the companies that are actually spending the money don't seem to be worried. CapEx budgets have actually been going up, not down. But to the extent that investors can get confident there's still more growth to be had as we go forward, I think that's sort of like for the long-term thesis, I think that's what's most important.
We are going to be tracking those earnings so closely, and we're going to use all of those points to evaluate them. Stacey, thank you. Appreciate it.
You bet. You bet.
Now time for some of today's trending tickers. We're checking in on shares of Novavax, Shake Shack, and some solar stocks. First up, Novavax surging today after its protein-based COVID-19 vaccine received its long-awaited approval from the U.S. Food and Drug Administration. And even though that approval came with some conditions, the fact that it happened at all was enough to send the shares soaring by about 15%, Josh.
Yeah, from what I read, Julie, they expected to secure approvals, I guess, for vaccine on April 1.
Right.
And then they faced these delays, and the FDA, I guess, asked for more data, so some relief from investors perhaps. Also Moderna, by the way, which of course also makes the COVID shots, that's enjoying a nice day in the green too, up about 6%.
Yeah, so the conditions on this is that the shot is okayed for adults 65 and older, and those who are 12 to 64 who have at least one underlying condition. So higher risk patients, basically, older adults and higher risk patients, not cleared for children, as far as I understand it. And really what this removes is a concern that Robert F. Kennedy, of course, the HHS secretary, was going to block this entirely.
Right.
So this is sort of, at least the market is reading it as a bigger indication of perhaps
something broader.
His attitude towards these types of vaccines, but we'll see if it goes beyond Novavax or not.
We will. All right, switching gears. Shares of Shake Shack, they're taking a hit today after being downgraded to a hold from TD Cowen. And so those analysts, they do cut the rating. They go to the sidelines with a hold. They talk about high valuation, saying the challenged restaurant spending backdrop limits further multiple expansion, particularly in the crowded burger category. They highlight also the big run since that 52-week low set in early April, Julie.
Yeah, they're also talking about marketing spending and that the company is not spending as much on marketing, which they say this might be, there's a stronger year-over-year benefit to sales from advertising because they're not going to be advertising as much. So that's one of the other things here. They also talked about digital offers are stepping up in the first half of this year, which may be an indication about demand here, that maybe that frequent customers need a little more sugar, need a little more of an enticement to get in the door.
So yeah, so they did take it down. The target stays at 105, by the way.
And then finally, let's look at solar stocks here, which are moving as a group today. For solar, Sunrun, Enphase Energy, they're all sinking after conservative Republican lawmakers said they had secured a commitment from leadership to end key clean energy tax credits earlier than planned. You know, this all part of the big tax bill trying to make its way through Congress here. And basically, the energy credits, there was a tax incentive for clean energy production, among other things, initially they were supposed to start phasing out in 2029 and then end in 2032. This reporting says it could happen earlier than that, but it's not clear how much earlier. But obviously there's a lot of sensitivity and concern around these credits more broadly and what this administration and Congress are going to do to various pieces of the IRA going forward.
Yeah, per Bloomberg, Representative Ralph Norman of South Carolina, who's helping to negotiate the package, it doesn't sound like we didn't provide a new time frame exactly, so we're not sure. And ultimately, of course, you still have to decide what do Republicans really do with this in the House, including those described as more moderates, and then, of course, then on to the Senate.
Yeah.
All right, America has a big blemish on its credit rating, but how are we moving forward in Washington and with managing our investments? We'll have that playbook for you coming up. Stay tuned.
Despite a volatile start to the year and continuing tariff uncertainty, large cap stocks have performed relatively well. Our next guest says that the market has recovered as if nothing has changed. We're navigating how to play large caps with the Yahoo Finance playbook. Joining us now, Brad Clapmeyer, Senior Portfolio Manager from the Macquarie Large Cap Growth Team. He manages the Macquarie Focused Large Growth ETF with $220 million in assets under management. So not just large cap, but large cap growth specifically, Brad. It's good to see you. Thanks for being here.
See you too. Yeah.
So I would ask you first of all about the round trip that the markets have taken, right? The big dip on tariffs, the comeback from tariffs. Now we're pretty much flat on the year, more or less. That's kind of true for large cap growth also.
Yeah.
Should that have been the trajectory? What is the market factoring in the full picture, I guess.
Yeah, unfortunately, I don't get to decide the trajectory, but I can analyze it. And I think what we've seen is investors coming back to the same playbook that they've been familiar with since November 2008, when we started quantitative easing, is that whenever there's some dispute or disagreement, you just buy the dip. Something will go the right way of the market. And unfortunately, what I believe is that's no longer the case. We had from November 2008 to really March of 2022, when we started quantitative easing, where I think the rule book has changed. We had zero rate policy going to higher rates. We had no inflation, a Goldilocks inflationary scenario, going to now a sort of anchored, embedded inflation. We had globalization now going to isolationism, and we're still trying to play that playbook that we had over the last 15 plus years. I think that's dangerous territory. So what I would say is, yeah, we had this emotion that pulled the market lower, and we had emotion that pulled the market up. Expect that for the next 5 years at least, is what I would say. There's going to be a lot of chop.
So you would actually define, Brad, did I read this right? You would define the market as super risky here? Talk me through that.
Yeah. I think from a super risky standpoint, it goes back to that narrative I just presented, where I think, 12 or 15 years ago, coming out of global financial crisis, valuations were very attractive in the market broadly. And so I would say at that time, if you had $1 to spend, put it in the market. I think that's why passive ETFs became so popular. Just invest $1 and to get it in the market. And unfortunately, we've kind of squeezed all the good out of that. And now valuations are pretty rich broadly, I think, and for growth stocks. So how we're handling that is we're using valuation discipline. We're putting quality before growth. We're just using a lot of discretion. I think just blindly throwing market money into a sort of concentrated market is just risky at this point.
Well, it's interesting because I look at some of your top holdings, and we got 5 of the 7 in those are the top holdings: Microsoft, Nvidia, Apple, Amazon, and Alphabet. Which I think you can argue, given earnings outlook, that the valuations aren't all rich. But I am curious why that. I mean, large cap growth, you only have so many choices. I understand that,
Yep.
But why sort of go into that concentration that's pretty close to what we see, for example, in the S&P 500?
Yeah, no, I think that's right. I think the first deciding factor is we have to decide, how do these companies get to this size of market cap? Like, do they deserve it? And we would say most of the Magnificent Seven do. We have disputes about the quality of the business with like a Tesla. We don't have a position in Tesla. We think it's an automotive company with a software layer, not a technology company that happens to make cars. So we're not interested in paying wild valuations for it. But I think a lot of these Magnificent Seven got there because these are some of the most phenomenal businesses we've ever seen. The risk now, and why we have taken different views of the quality of those businesses now, is that they're all highly correlated to one thematic. And that thematic is cloud compute and AI. So we're not thrown off by the fact that the market is concentrated, but we call it blind concentration into thematic versus what we're trying to do with the Macquarie Focus product is do intentional concentration, really think through how a portfolio comes together. We don't want to give an investor a beta portfolio or AI thematic portfolio if they're trying to invest in a quality growth portfolio. And to me, that describes this risk in the market. All of a sudden, we ended up with a group of great names. That's right, but the fact is they're all highly correlated to a single thematic. That's risky, and I think people need to really think through the process of what they own in their passive investments.
So there is risk, Brad, but I know you think there's also opportunity. Yep. High level, broadly, I know one area you continue to like, data center REITs. Correct. How come?
Yeah, I think you have to be careful with the REITs, first of all. There's not a lot of differentiation in sort of the retail REITs. They're very popular right now because we're obviously expanding the capacity that we need for compute. The name that we think is just exceptional quality in the REIT space is a company called Equinix, EQIX. And the reason why we like it is they just have the most phenomenal locations in the world. They have what's called cross connects and interconnects. So if, let's just say you're Nike and you want to connect with the Salesforce platform, you want to be in a location together so you can have that low latency, you can speed it up, you have this privacy to it. And believe it or not, that's called a network effect. If you can get all these wonderful businesses in the same location and they're all cross-connecting to each other, no one's going to jump ship and move to across the street. It's just impossible. So we love the network effects here. And I think what we're going to find, this is our hope and why we like the business, is they're going to take that advantage of locations and what they're doing with those cross-connects. And as some of these AI training models get put into production, same thing, you want low latency, you want to be on the edge, you want to be connected with your partners. And we think they have a real competitive advantage to really emphasize their value as we move into productive AI.
Brad, great to see you today, especially on set. Thanks for coming in.
Yeah, thank you.
A Moody's downgrade of the U.S. credit score reverberated through financial markets Monday, but the response from Republicans crafting a bill that could add trillions in new red ink was to immediately try to minimize the news. For more, let's welcome in Yahoo Finance's very own Ben Worschel. Ben.
Yes, hey Josh. So it was a remarkable kind of story today that you guys had a really exciting day in the markets in response to this Moody's downgrade. But here in Washington, especially amongst lawmakers and amongst the White House, it was sort of an overall attempt to downplay the news and appear unfazed by it, even as this Moody's statement did call out the White House or the Republican bill directly. It estimates that just extending the 2017 Tax Cuts and Jobs Act, which is only one piece of this bill, would add $4 trillion in deficits in the decade ahead. So the White House dismissed it, and lawmakers even rushed ahead to try and they advanced the bill on Sunday night, late Sunday night, out of the Budget Committee. They have another hearing, believe it or not, at 1 a.m. on Wednesday morning in the Rules Committee to advance it further. And this is all as they sort of march as quickly as they can to try and get this out before the Memorial Day recess. A final vote in the House is expected on Thursday to do this. And this is a bill that could add trillions of dollars in deficits to in the years ahead, based on a whole bunch of analyses.
Well, let's dig into that part of it for just a moment here, Ben, because President Trump's economic advisors are making the case that the bill is going to save $1 trillion. What are we hearing from outside analysts about this?
Yeah, so the White House case, which is contained in a new report from the Council of Economic Advisors this afternoon, is that it's the opposite story in terms of what this bill will do. Caroline Leavitt, the White House press secretary, said it will save $1.6 trillion. That's a $5 trillion gap from a range of other analyses. You heard the Moody's one was $4 trillion, the Committee on a Responsible Federal Budget, the Joint Committee on Taxation, and we had another one this afternoon from the Penn Wharton budget model. They all find a sort of $3 to $4 trillion debt increase in red ink from this. So it's a huge gap. And the White House tries to explain the difference basically by saying that economic growth will be so supercharged from this that that'll make up the difference, that the economy will boom to such an extent that the revenues will outmatch that. I'll say there's not a lot of evidence for that, considering a lot of this bill is an extension of the 2017 Tax Cuts and Jobs Act, and we sort of know how much that grew the economy, and it wasn't at the levels they're talking about. The White House also says other things like tariff revenues, deregulation, all these things should be factored in and will make the fiscal picture much better. But again, it's an analysis not a lot of economists agree with, and it sort of sets up a time ahead where we have this huge gap. I mean, $5 trillion is a pretty whopping number to have, and it's that I think we're going to hear from both sides as we go forward.
Ben, great to see you. Thank you, sir.
Sure thing.
Well, for more now on today's moves and what they mean for investors, let's welcome in here Kenny Polcari, Slatestone Wealth Chief Market Strategist and host, of course, of the Yahoo Finance podcast, Trader Talk. Kenny, always good to see you.
It is always a pleasure to be here.
Let's start with the news of today Ben was just talking about. So Moody's makes its move. They cut the credit rating. Investors seem to frankly look through it, but I'm curious to get your take.
They did. Well, this morning it was all the nervousness, right? Because it was S&P cutting the rating, making this whole drama about it. But the truth is they just fell in line with where S&P and Fitch have been, right? When Moody's cut the rate. So they brought us in line to where the other ones are. Now, it's kind of consequential. Why'd they wait till now? Why did they wait till after you get back and you had all these deals? Why are they waiting until they're about to vote on this bill? So it was a little bit in my mind curious. One way or the other, the market got nervous this morning. But now look at this. At the end of the day, the market's basically flat. I think the Dow is up and the S&P is off by $1 and NASDAQ's down a little bit because I think the investor is going to look through it. Because look, we all know that stuff like this creates short-term chaos, but in the end doesn't price stocks long-term, unless, of course, to this case, if they don't follow through, if this whole tax bill that they want to pass, if it doesn't create growth, then yeah, it's gonna be a problem. But the idea is that this tax bill is gonna create growth, right? If GDP grows at 4 or 5%, then this isn't even an issue.
It's still an issue, though. Well, let me backtrack a little bit. People have been talking about this issue for years.
100%.
Debt has been growing and growing and growing and growing. We're at 100% of GDP, and it's only going to go up from here, according to any analysis you look at. I thought Jim Reed of Deutsche Bank had an interesting quote today. He says this downgrade shouldn't shock anyone. He's called it another small crack in the edifice. It's only a problem if people decide to stop buying our debt.
That's right.
And is that ever going to happen? Maybe, but who knows?
They've been saying it for how long that people are going to stop buying our debt and foreigners are going to stop, and they really haven't stopped. Now, someone's going to pull out an analysis saying that foreign buying is down for our 30-year debt and start to create all this hysteria. I think that's just what it is, histrionics. I don't think the foreigners are going to come and stop buying U.S. debt. U.S. debt continues to be the best debt you can buy, right? So if you want safety, you're going to come here and that's what you're going to buy. Now, could it get rocky? Sure, it could get rocky. If in my mind, they need to be a little bit more aggressive in cutting spending, for sure. Then, this Medicare thing, they push out till 2029, before it really kicks in, the cuts in Medicare. They really have to bring that forward and make some of those cuts happen now, right? They have to happen in 2026, not 2029.
Go ahead, sorry, can I cut you off?
So I think that's going to be more of this conversation that takes place over the next couple of days here, and then when it goes to the Senate.
Let me ask you finally, SPX at 59.50, what levels am I watching?
So here's what you're watching. The long-term and intermediate are converging at 57.70, right? So that's going to be your first level on the downside that you're watching. If they fail there, remember the gap we created on Monday last week when we went from 56.91, we opened, there was this gap in the market. So I would not be surprised if we have a pullback. If 57.70 doesn't hold, I think it will because there's two trend lines there. But if it doesn't, then I think it's going to come back and fill that gap at 56.91 and churn for a little bit and then start to make its way higher. Now, look, doesn't mean it's going straight up. I think it's going to churn in here for a while between 5,700 and 5,900. I think that's where it's going to be for a while as it kind of digests all this information that, is getting thrown at us. So I don't think anyone should worry about a panic that we're going back to 48.35. I don't think that's happening. But nor do I think we're running away either, going to 6,400 by the end of the year.
Okay, good to see you. Thanks
Always
for coming
a pleasure.
in.
Thank you for having me.
Be sure to tune into Trader Talk every Wednesday at noon Eastern. You can scan the QR code below to stay up to date with all of the latest episodes. We'll be right back.
23 DNA testing company 23andMe is being purchased out of bankruptcy. Drug maker Regeneron to acquire the biotech company for $256 million. And Yahoo Finance's Anjali Kamlani joins us now with more. Anj.
That's right, Josh. We heard this morning from Regeneron that they did win the bid to acquire 23andMe, and that is pulling it out of bankruptcy where it has been for the last few months. As we know, the company has struggled despite having a popular DNA testing at-home kit. And it also kind of helps, this bid kind of helps cement a strategy that 23andMe had actually tried to pursue many years ago on its own, and that is to really link up its DNA database with the pharmaceutical industry and trying to discover treatments. So this bid for $256 million is now what is focused on with this court proceeding. They have until June 10th for any objections to come through, as well as until July 1st is when they can initially close the deal. So that's when we have the timeline to look out for. The business is basically everything to do with the genetics business, so nothing to do with the telehealth, the pharmacy fill, as well as the lab processing business that 23andMe has. That includes Lemonade Health, that's a telehealth services. So this is just wrapping up, what Regeneron really is focused on here is the data bank, and that really is already something that the company says that it has already done. They have about 3 million users data and are now looking to add what 23andMe has. I did inquire about the privacy. They have made an emphasis on ensuring data privacy. We know that, of course, that 23andMe suffered a data breach recently, so that's one focus. And then in addition, we know that the California Attorney General had put a specific focus on profiles and encouraging users to delete those profiles. Regeneron said that they are really focusing on that aspect of it to ensure that those who have already had their information in the system feel secure about that. So a lot going on, with respect to what happens to that data and how the company will exactly use it, whether or not it is going to be part of their research center or continue to do the drug discovery. We'll have to hear more as soon as those plans pan out.
Anjali, thank you so much. Appreciate it. Sticking with healthcare here, shares of United Health Group rising as new CEO Stephen Hemsley buys about $25 million worth of the company's stock. And the move higher comes after shares have taken major hits in recent sessions. From pulling guidance to facing legal woes, the health insurer is navigating several headwinds. Here with more on the ripple effects is Mizuho America's healthcare and equity strategist, Jared Holtz. Jared, it's good to talk to you as always about these kinds of issues. Those of us who have been watching what has been going on with United Healthcare as of late, I want to look at the big picture first of all. What does it tell us about the broader health insurance economy? Or is it so sort of UNH specific that we can't extrapolate?
Great to see you, first of all. It's probably a little bit of both. Really difficult to tell whether it's company specific or industry specific because we've gone through such a prolonged period of higher medical cost trend, higher utilization, and in some periods you see the entire industry, kind of grapple with it. In other quarters, United may be the one that's afflicted the most, or it could be a peer. So it's not exactly clear, I guess, to answer the question. It just seems like in the most recent periods, United's gotten hit the hardest.
Jared, when your clients ask you what to do with this one, what are you advising them, Jared? I mean, the headlines have been rough, but the stock has been nailed. So I'm just curious in the guidance you're giving.
Yeah, I've been basically saying stay away over the near term. It's not like I don't want to be bullish or want to like the stock at this price. I mean, it's gotten cut in half over just a couple of months. So there's a lot of opportunity here, most likely over the medium to long term. I just feel like there are too many things going on, right? The changing of the management team at the CEO level, no guidance from the company, which will change over the next few months. I would imagine they would give some sort of financial forecast on the second quarter earnings call. And then third, this DOJ investigation, which may or may not be material. It just seems like with thousands of other stocks to go by, there are probably better situations than this one. That being said, I think the valuation is obviously on your side as it's come in a lot. The problem is we just don't know the numbers. So I've just been advising, I understand the intrigue, but I've just been advising stay away either way.
And Jared, what is the risk here that it could get taken out of some of the indices, for example, and then by extension, would lose out on being included in indexes that people are buying and or ETFs that track those indices?
Yeah, I'm not too sure. I mean, I wrote about this late last week, had just been getting questions on, the various scenarios, whether this was a possibility or not. I think that we've been through, various situations with other blue chip companies historically, whether it's Boeing or Intel, and there really is not a clear-cut situation in which a company would be removed. I think what makes this one a little bit unique is that, to lose $300 billion worth of value over, a couple of months is fairly notable. I don't think we've seen that before, but there's not really a precedent. I mean, usually an index like the Dow doesn't love volatility. It likes its companies to kind of be steady. This one has not been over, the recent years, but there's not like a hard and fast answer on it.
Jared, we mentioned in the intro there, UNH execs, they have been buying shares. So per Bloomberg, Hemsley buys 25 million. It looks like he's not the only one. The CFO buys 5 million. What do you make of that? Should investors make anything of that?
Yeah, I mean, optically, it looks very good. I mean, we don't really know the circumstances in which they're buying. How much of that is contractual, for a new CEO to step in. If you were to assume that, this is all, due to the fact that the stock has come in a lot and it's opportunistic and the management team and members of the board, I think a few of them last Friday bought stock, then, they're showing levels of optimism or excitement that the stock is here and the fundamentals don't really reflect what's going on, or the stock is not really reflecting longer term fundamentals, then it's obviously a positive. I mean, I think that's why the stock has ricocheted so hard off of Thursday's low. But, you know, other than that, I don't really know. I mean, we've seen executives buy stock time and time again across this sector and others. Sometimes it is really, you know, a very meaningful event, and sometimes it's not. But it is kind of intriguing to see so many of them buy at the same time here.
Jared, would it be, are there other competitors that are taking advantage of this situation to take market share? Or, because it seems like the Medicare Advantage business is troubled, they don't want that business?
Yeah, I mean, I think part of the problem is that United over the past couple of years has been a share taker. They've absorbed some of these patients from Aetna, from other companies that have decided they don't really want to underwrite these sort of lives, these riskier dual eligible or Medicare Advantage lives, because they felt like they couldn't properly account for the risk. And I think that's where we are now. That is why, or that's one of the reasons why United is facing these struggles, is because they have been a share taker. And the best idea, even though it's kind of antithetical to the business, is to actually lose share given the utilization cycle. But when things kind of reverse the other way or revert the other way, United could be a beneficiary if utilization trends go downward.
Jared, always great to see you and to have you on the show. Thanks for joining us.
Thank you guys so much. Appreciate it.
And while we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.